Okay, let's just cut right to it and talk about a feeling I know you've either had or you know someone who's actively dealing with it right now. We are living in this intensely uncomfortable modern financial reality. Picture this. Somewhere right now at like 3 a.m., someone is in a cold sweat, completely panic selling their stocks. Somewhere else, an exhausted worker is riding the subway, aggressively refreshing a glowing green and red app, just desperately trying to figure out how to escape this deep, gnawing financial anxiety. We literally have an entire TikTok-fueled generation watching crypto charts explode upward, completely terrified that they are missing out, just looking for any way to stop feeling so incredibly far behind. And the brutal truth is, right now, someone is literally losing their entire life savings trying to beat the system. You know, previous generations, they might have laid awake fearing global wars or famine. But today people are constantly terrified of irrelevance. They're terrified of inflation. They are terrified of falling behind the algorithm's constant quiet whispers that you are too late. Oh, you didn't buy Bitcoin in 2014? Too late. Missed the AI boom? Too late. Real estate? Don't even think about it. For so many of us, money has completely stopped feeling like a simple tool for survival, and it's morphed into this massive, overwhelming measure of our social identity. But here is the wild part. Amidst all of this anxiety, all of this existential dread, people just keep pouring their paychecks into the market, month after month, year after year. Which brings us to the core mystery of this entire explainer. And honestly, it's kind of terrifying when you really stop and think about it. Where is all that money actually going? Because behind every individual stock you pick, behind every trendy ETF your favorite influencer talks about, and hidden deep beneath your automatic 401k and retirement accounts, almost all of our money is flowing directly toward one massive, hidden destination. And here they are, Vanguard, BlackRock, and State Street. The big three. Just to put this into perspective, together these three entities manage more wealth than the GDP of most countries on Earth combined. Now, naturally, when the Internet Collective figured out exactly how much power these three companies hold, it did what the Internet always does, right? It invented a massive, sprawling conspiracy theory. You will see endless Reddit threads and viral YouTube thumbnails calling them the shadow government or the puppet masters secretly controlling the world. But I'm going to tease something a bit more fascinating here. The real truth of how these companies acquired this absolute mountain of power isn't about secret societies in dark, smoke-filled rooms. It is actually far stranger, and it is deeply, deeply psychological. To really understand this, I want you to play a quick mental game with me. Imagine, right now, I just handed you $1 million. Cold, hard cash, real money. For the first 5 seconds, you would feel incredibly empowered, right? Like you could take on the world. But almost immediately, and I mean literally within minutes, that empowerment turns into pure, paralyzing fear. Why? Well, because now you actually have something to lose. The modern stock market activates the exact same emotional circuitry in the human brain as a casino. It just floods your system with dopamine, greed, panic, regret, and euphoria. You open up YouTube and one guy is yelling at you to buy gold, another is promising that AI is the only way to survive, and suddenly, that $1 million feels incredibly dangerous. Because of that immense, totally human psychological fear, we created this simple, almost childish rule. Never put all your eggs in one basket. Diversification. It became the absolute, unquestioned foundation of modern investing. And there's a good reason for it. History absolutely humiliates certainty. The market is basically designed to punish arrogance. That's why diversification exists. It's our psychological shield. It's meant to protect us when massive, supposedly invincible giants, like think of Nokia or Blockbuster or Lehman Brothers, when they suddenly just collapse into absolute nothingness overnight. So that brings us to part one of this explainer, the illusion of experts. For decades, society totally bought into the myth of the Wall Street genius. You know the archetype, the guys in the $5,000 suits, acting like untouchable financial prophets who could literally see the future. But then, back in 1974, this Nobel Prize-winning economist named Paul Samuelson pointed out something that absolutely shattered that illusion. He realized that many of these highly paid, actively managed funds actually fail to beat the broader market once you account for their massive fees. To put it bluntly, the so-called geniuses were literally performing worse than the chaotic, random market itself. And this realization perfectly sets up the core financial conflict of the modern era. Look at it like this. On the left side, you have traditional Wall Street's profit model. It's all about constant movement, hypercomplexity, outrageous fees, and basically feeding off your constant fear of missing out. But on the right side, you have this guy, a Princeton-educated man named Bogle.
And Bogle had this radical, almost offensive idea at the time. He basically said, hey, we should just stop trying to beat the market. Let's just become the market. His method was cheap, it was passive, it was agonizingly boring, and it was driven entirely by something humans naturally struggle with: pure patience.
Now, tracking the psychological evolution of Bogle's idea reveals an absolutely incredible timeline of human behavior. It starts way back in the exhausting, fear-driven stagflation era of the 1970s. Then it moves through the quiet creation of the very first index funds and ETFs. It manages to survive the absolutely devastating 2008 Lehman Brothers collapse, and then it barrels straight through to our modern era today, where even aggressively anti-establishment assets, like Bitcoin, are fully absorbed by this exact same Wall Street machinery. Let's rewind back to John Bogle for a second. After he left Wellington Management, he launched a brand new company and named it after a British naval ship, the HMS Vanguard. In 1976, he debuted his S&P 500 index fund. It didn't try to predict the next big tech boom or the next oil crisis. It literally just bought the entire market. And you know what Wall Street did? They relentlessly mocked him. They laughed him out of the room. They literally called his fund Bogle's Folly. Because fundamentally, human beings absolutely hate average returns. We don't want steady, boring discipline. We are wired to want shortcuts. We want explosive gains. We want to be overnight millionaires. And the launch totally reflected that psychology. When Bogle launched his fund, he was hoping to raise somewhere between $50 to $100 million. But because Wall Street hated the idea, and because everyday humans crave the excitement of a gamble, he barely scraped together $11 million. Literally, everyone thought the idea was dead on arrival. But then, reality happened. As the market slowly and painfully recovered from the aftermath of the 1973 oil crisis, Bogle's incredibly boring, patient philosophy just quietly kept working, year after year after year. And then, investing evolved again, taking that passive idea and weaponizing it for convenience. In the 1990s, a guy named Nathan Most had a truly revolutionary idea. What if you could trade these massive, broad index funds instantly, exactly like you trade a regular stock? This brilliant spark led to State Street launching the SPY ETF in 1993. It was a total game changer. Suddenly, all the friction, the annoying paperwork, the expensive brokers, the multi-day delays of traditional investing, it was all completely removed. You could buy a tiny, perfectly sliced piece of the entire American economy with zero hassle, right from a computer. But here is the fascinating psychological catch. John Bogle actually hated ETFs. He deeply understood human psychology, and he was terrified that removing that friction would turn investing into mindless entertainment. And honestly, he hit the nail on the head. He was completely right. This modern, infinite aisle of ETFs has completely weaponized our dopamine. The supposed democratization of finance basically turned the stock market into infinite emotional scrolling. Today, every single push notification is emotional. Every little red dip on a chart feels catastrophic. Everything from green energy to artificial intelligence has been sliced up and financialized for our immediate addictive consumption. Which perfectly leads us into part 2, the architect of scale. So, the 2008 financial crash completely and utterly changed the landscape of the world. The total collapse of Lehman Brothers shattered people's identities and destroyed lifetimes of wealth. But inside that utter panic, inside all that blood on the streets, a massive psychological opportunity presented itself. A man named Larry Fink used his deep background in risk management to completely capitalize on that post-crash fear. While everyone else was terrified, he bought Barclays' iShares ETF business in 2009 for an unbelievable $13.5 billion. He made a massive bet, knowing that the future of finance belonged to giant asset managers, offering people the psychological illusion of safety at a massive scale. And that aggressive move is exactly what brings us to today. Vanguard, BlackRock, and State Street now manage tens of trillions of dollars. Trillions! They are the major shareholders in almost every massive corporation you interact with on a daily basis. The phones we use, the medicine we take, the media we consume. But here is the real kicker. They didn't get here by launching some hostile supervillain secret takeovers. No, they own these massive stakes simply because ordinary people, like you and me, relentlessly and automatically auto-invest our 401ks and retirement funds into these passive index systems every single month without even thinking about it. And that brings us to part 3. Absorbing the rebellion. Let's look at how powerful this machine really is. Even Bitcoin, an asset that was literally fundamentally designed from the ground up to be the ultimate anti-establishment escape hatch from centralized Wall Street institutions, even Bitcoin was ultimately financialized. In 2024, spot Bitcoin ETFs were officially approved in the United States. And by 2025,
financial giants like BlackRock had collectively absorbed over 1 million bitcoins. Just think about that psychological twist for a second. The system is so powerful that it literally monetizes the very resistance against it. Even a decentralized anti-system rebellion eventually just gets wrapped up in a nice little package and sold to us as a convenient ETF. But okay, let's take a second to directly address those internet conspiracy theories. Do the big three actually control the world from a secret underground bunker? Look closely at the real numbers here. Take Apple, for example. Yes, Vanguard is a massive shareholder, but they only own around 8 to 9% of Apple. The other 90+% is owned by a fragmented ocean of other shareholders. Tim Cook does not wake up in the morning and wait by the phone for Vanguard's permission to update the iPhone camera. The reality of how this power works is much more nuanced, and frankly, it's a lot more boring than the shadowy internet conspiracies want you to believe. Which finally brings us to part 4, the real conspiracy. The profound, slightly uncomfortable psychological twist here is that the big three aren't a shadow government pulling the strings of humanity. They are literally just businesses responding to our collective demands. We have to be willing to hold a mirror up to ourselves here. The market does not care about morality, it only rewards demand. These giant asset managers, they just follow the money. If tomorrow the entire world exclusively demanded highly ethical, peaceful investments, the industry would adapt to sell us that overnight. If weapons or fossil fuels go up, people will often abandon their ethics to chase the returns. We are the actual, breathing architects of this giant financial machine. When John Bogle passed away in 2019 at the age of 89, his advice for everyday people remained exactly the same as it was back in the 1970s. Stay the course. Just ignore the noise. On paper, it is incredibly simple advice, yet in practice, it remains psychologically torturous for human beings. We naturally crave certainty. We crave action. We desperately want that immediate viral dopamine reward. To sit still and do absolutely nothing while the rest of the world is seemingly panicking on Twitter, it goes against every single primal survival instinct we have. Because at the end of the day, no one, absolutely no one, not your favorite YouTuber, not a tech billionaire, not a politician, and definitely not an economist, can predict the next boom, the next sudden market crash, or the next global conflict. Every single time you buy an ETF, every time you let that chunk of your paycheck slide into a retirement account, you are ultimately making a deeply psychological bet on the future of humanity itself. You are quietly asking yourself, do you believe civilization keeps building, or is it inevitably collapsing? I want to leave you with this really profound quote from Warren Buffett. Because underneath all the flashing financial apps, the terrifying high-frequency algorithms, the 3 a.m. panic selling, and the endless, exhausting fear of missing out, investing is driven by something much, much deeper. The market transfers wealth from the impatient to the patient because ultimately, the entire global financial system is powered by the oldest human emotion of all, hope. So the next time a chunk of your paycheck automatically flows into a massive index fund, just ask yourself, are you just buying a tiny piece of the market? Or are you casting a vote on the future of human civilization? Thank you so much for joining me on this explainer, and I'll see you in the next one.